In this video, I'll talk about credit scoring applications in financial risk management. You probably have heard about credit score and credit history. Credit history is basically your permanent record related to finance, such as car loans, student loans, mortgage, credit cards loans, etc. It stores 7 to 10 years of history of payments. Payments can be payments to credit cards, mortgage, and loans in general. It also stores creditors' judgments, however, can be removed before 7 years. A credit score measures how risky you are to a creditor or lender, and measure how much lenders can make off of you. When you apply for loans or a credit card, having good credits also means it is more likely to get approved. Having good credits also means lower risk and lower interest rates. It may mean lower insurance premiums as well. Users can check history, here credit history for free on several websites such as annualcreditreport.com and creditkarma.com. The good thing is checking your credit history will not hurt your credit score. And this is different from lenders checking your credit history. In the case that you find mistakes in your credit history, then go to annualcreditreport.com and select a credit bureau and request for credit history correction. Usually you may get an email within a few days. Now talking about credit scoring in the US market. There are several credit scores. The first score was FICO scoring system introduced by Fair Isaac Corporation in 1989. FICO was main player for a very long time, until 2006, when the newcomer called Vantage Score came in. Vantage Score uses similar scoring methods to FICO, but with slightly different results. The score is the result of a collaboration between the three major credit reporting agencies, including Experian, Equifax, and TransUnion. Also, some industry-specific scores exist as well. Now let's take a look at key factors in credit scores. The first is payment history, which accounts for 35%. If you get a loan, it is very important that you pay on time. Usually, lenders report to credit bureaus after 30 days of being late to pay bills. The second factor is amount of debt, which accounts for 30%. Basically, this is the amount owed compared to the total amount of credit limit. The rule of thumb should be less than 30%. Here we have an example. Let's say you have two credit cards. Card 1 with 10,000 credit line and 5,000 balance. Card 2 with 1,000 credit line and $200 in balance. The sum of the balance divided by the sum of credit lines gives you 47%. The third factor is the length of credit history, which accounts for 15%. Basically, the longer your accounts are open, the more positive impact it is on your credit score. Even if you have a card that is very long time ago that you don't use, then just keep it, even it has no activity. The next is credit mixed, which accounts for 10%. If you have a mixture of loans, even closed loans, that helps show creditors that you have experience in borrowing money, and this is a good thing. The last one is credit inquiries, which accounts for 10%. Credit inquiries include hard inquiries and soft inquiries. Soft inquiries are usually from yourself to check your credit scores and credit histories, and hard inquiries are usually from lenders. Hard inquiries usually can hurt your credit score, especially if you have multiple hard inquiries within a short period of time. Talking about the ranges of credit score by FICO and Vantage. FICO scores range from 300 to 850. Vantage score has the ranges from 501 up to 990. Credit bureaus such as TransUnion, Experian, and Equifax also have their own credit ranges. Talking about scorecard applications for credit scoring. The slide shows an example for a scorecard. The first column shows several variables such as age, home, and income. Each variable is binned or discretized into multiple groups or categories or bins. That's where you see for attribute, which is in the second column. And the last column shows the scorecard points for each bin. So let's say if the cutoff score is 600 points and you have a new customer that applies for a credit card. And let's say the age is 35. The income is about 38,000 and he owns a home. Using the scorecard, you can find that with age of 35, we get 210 points. And similarly, for income of 38,000, we get 225 points. And finally, for owning a home, we get 225 points as well. The total is 660 points, which is greater than the cutoff scores. So here we say the decision is to grant credit. The scorecard format is the most commonly used in the industry. It is an effective tool to manage risk in a number of industries, including banking, finance, insurance, etc. The scorecard format is easiest to interpret for people without advanced knowledge of statistics or data mining or machine learning, etc. Also, reasons for declines, low scores, high scores can be explained easily to customers, auditor, regulators, management, and etc. in simple business terms. Because it has been used for long, so the development process is very much standard and widely understood. And it is easy to diagnose and monitor using standard reports. Now we go through the steps in a typical scorecard application. One of the first typical steps is feature discretization, which reduces the number of values by grouping them in a number of intervals or bins. Usually, there are two different ways. Supervised discretization, or unsupervised discretization, which means that labels can be used or not used. For unsupervised discretization, there can be equal interval width, equal frequency, and clustering approach, such as k-means. The equal interval width approach divides the range of attribute values into n intervals of equal width. Another approach is equal frequency, which divides the range into n intervals, and each interval contains approximately the same number of observations. A clustering approach such as k-means groups observations into k-clusters, and k is given, in which each observation belongs to the cluster with the nearest centroid. For feature selection, typically information value is used for scorecard applications, and it is important to note that all the continuous parameters should be discretized. The good thing for using information values and later on also weight of evidence is that missing data is considered as a separate category. Talking about weight of evidence measures the strength or the total strength of each bin in separating good and bad examples. Basically, it is a log of distribution of good divided by the distribution of bad times 100. The negative values indicate that a particular bin has a higher proportion of bad applications than good applications, or higher proportion of bad applicants than good applicants. Once we have the weight of evidence, which measures the strength of each bin, then we can use information value to measure the total strength of the variable. And basically, it is the weighted sum of the weight of evidence for each bin in the variable. The weights here is the difference between the distribution of good and the distribution of bad examples. Information value can be used to rank and select variables very quickly. Feature transformation transforms the original data into weight of evidence. So in general, there are two steps. The first step is grouping. For continuous variables, we split each variable into a few bins. For discrete variables, we can either leave them or group them for each variable into just a few bins. And then the second step, calculate weight of evidence value for each bin and replace variable values by weight of evidence values. Logistic regression is explained in a separate video or a separate lecture, so I don't redo it here. We move on to the scoring algorithm. After logistic regression, we know the coefficients for the variables in the model. So from there we can easily calculate the unscaled score for an individual I. The score is S, which is a linear combination of the coefficients and the weight of evidence. We can add some scaling parameters to the model, which are shift and slope here. Shift and slope are to make scores to conform to a particular range of scores. This formula shows how to calculate the base points separately from points for individual predictors. The next formula shows how to calculate the score points for the jth predictor, and here still for the individual I. And finally, considering base points, then the score points for the individual I, the jth predictor, is calculated using the third formula. P here in the denominator is the number of predictors. Talking more about scaling, scaling is to make the scores to conform some standards. One of the most common settings is that the odds doubling at every 20 points. In the formula, PDO stands for points to double the odds. The shift and the slope parameters can be calculated based on knowing that points is the shift plus slope times the log of the odds. And the log of the odds is actually the linear combinations on the right side of the logistic regression model. Adding PDO on the left and twice the odd in the log on the right, then we have a system of equations. And from there we can easily solve and get the slope and the shift. Now let's look at an example. A scorecard is being scaled to have the odds of 50 to 1 at 600 points, and PDO, which is points double the odds of 20. From there we replace into the formulas for slope and shift and calculate the slope and the shift and plug them into the formula for the score points. This same formula can be used to scale the scorecards to triple or quadruple the odds for some number of points. But points to double the odds is most widely used in credit risk industry. Another alternative is to use the worst and the best scores to find shift and slope parameters. So given worst score and best score, plug them into the system of equations. We can find shift and slope, and here S mean and S max is calculated using the coefficients of the logistic regression model and also the weight of evidence for each predictors. For the unscaled S mean, then we have mean here and there and there. And for S max, you also have max correspondingly. Now talking about adverse codes. Lenders are required to give borrowers reasons for declining the applications. And this can be done using adverse codes, which can be generated by using a neutral score, which is a score points where the weight of evidence is 0. So for the jth predictor, we can get points for that predictor, and Then compare with neutral score to give the reason of declining to the borrowers.